Today I'm going to cover what is going on in Japan and how that relates to the hyperinflation that occurred in 1923 in Germany. A lot of similarities. I will explain. Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is June 27, 2023. We'll jump right into it. The reason I put this picture up, this is a kind of a well-circulated picture. You've probably seen it before. It's this young lady is stoking the fire, building a fire with German marks, paper German marks. People would, in 1923, the mark became so worthless that people would paper their walls with them. They would light fires with them. They were completely worthless. They were worth such a minuscule percentage of a penny that it's not even worth talking about. And they would do things like this. In 1919, following World War I, Germany was confronted by our allies, mostly in Europe, for paying for the damage that they did throughout Europe. And the countries were mostly the UK, France, Belgium, and even Japan. And they signed a treaty where Germany would have to pay. Well, the problem is Germany was deeply in debt. They had spent all of their money on the war, which they started, and they didn't have the money to pay. It was way in the billions, even in those dollars, it was billions, and didn't have the money to pay it. They did manage to pay a portion of it. They scheduled payments, and so all the way up to 1930, and then Hitler got elected, and we know what happened after that. So part of the debt just went unpaid. But in 1919, the 9 German marks were the equivalent of $1 US. Germany printed so much money in order to pay this debt that because they couldn't borrow it because they were already deeply in debt, they printed so much money that the equivalency in 4 years, from 1919 to 1923, went from 9 to 1 to 4.2 trillion marks to $1. So it became worthless. And there's a picture of it. Now this picture only takes you to 1 trillion. It actually was 4.2 trillion. And you can see just in approximately most of that, nearly all of that occurred in a 2-year period of time. So what started out with a problem, we've got to pay this money, and went into printing money, which went into hyperinflation, and they were already deeply in debt. So they tapped 2 sources, 1 printed money and 2 debt, and at that point their currency collapsed. And it was very severe times in the 1920s in Germany. Bring it forward to today, and you have heard that the rate of inflation, or the CPI, Consumer Price Index, which is used to measure inflation, and I definitely put that in quotes because it's not inflation, and the rate, the CPI rate today is said to be 4% year over year, 4% from last year to this year, measuring it the way the government measures it. But the government excludes food and energy, and then they use a substitution method, which I will show later. The Chapwood Index, if you have not heard about this, you might want to check it out if you're interested in this subject. The Chapwood Index is a better measure. It's a very good measure. I won't say it's precise, but it's as precise as I've seen. They actually measure inflation. They measure 500 items, the most purchased items in our economy by city. So they measure 500 items in 50 different cities and give you to 1/100th of 1% what the rate of inflation was compared to 12 months ago. That is a real rate of inflation. That's what you're experiencing, not the 4%. So I went to their website, I took a picture, this is on their homepage, took a picture of just 10 of them. There are 50, so I didn't show you all 50, but you can go to the website and you can see by city, all 50 cities of where it is, and then I put calendar year 1922. So all the way through 1922, this is what those particular cities had. If you measure it based on the least inflation to the most inflation, the cities with the highest inflation were 15%. The lowest inflation was 9%. The mean is about 12%. I'm from Seattle, so I went and looked at Seattle. That was 12%, which is right at about the mean. Not 4%. 12 is a long ways away from 4%. The Federal Reserve wants their target rate is 2%. So let's say it comes down to, and let's just hypothetically say that the mean comes down to 10. It's probably going to be something like that. So if it's down to 10, every model that you've ever seen doesn't work. The traditional financial advising industry, their models don't work. They're based on the assumption that we're going to have a 2 to 3% inflation rate, and they say it with absolute conviction, and they're absolutely incorrect because that is not the rate of inflation. And their investment models don't work, their financial planning projections don't work, and they're unwilling to depart from that. But if you want to factor something in, I would say factor in 10%, and that's not a high number, that is probably as realistic number as I can get. Now, you've seen me before show a picture of the alternate CPI done by economist John Williams on his website, shadowstats.com. And this is a chart from 1980. He has documented this month by month since 1980 with white papers. So all the research, all the documentation is there. And he puts back in the food and energy, which are subtracted out of the government numbers. Of course, that's disclosed. And the other item, which is a big item, is the substitution index, the substitution items in the index. So what that means is if an item goes up too much from one year to the next, let's say it goes up 10%, and they want to get that number down to 2%, then they substitute a cheaper item in the second year, the current year, in order to get the rate of inflation down. So the red line in this chart shows what the government, it's charted since 1980, what the government data shows to be the CPI, called inflation. Of course, it's not inflation. The blue line is him putting back into that number the actual, the items being subtracted and the items being substituted. So it's a careful study. So that's not unlike what we were just talking about here with the Chapwood Index, that when this gets to about 12% currently, this is where you live. And you know this because you shop, you buy things, you buy them online, you buy them at the store, you go out to eat, you pay your utility bill, your insurance bill, etc. You know they're not going up at 4%. It does. So this is documented. Now, that's where we are in the US. So I'm going to get to Japan in just a minute. I took this from John Rubino's this current week's blog, and this is from wolfstreet.com. This is a chart showing, going back to 1981. This shows, so it's about 40 years of data. This shows the rate of inflation in Japan Again, minus food and energy, so it's not a real number, but it's what they use for CPI. Do they use substitution in Japan? I don't know. Maybe they do. But the rate of inflation, not unlike the US, is the highest it's been in 40 years. And it's climbing. Now, you know that chart I just showed you from John Williams and shadowstats.com? Did you see how it came back down at the end? You see that? Look at Japan. It did not come down. Why? What's going on? Didn't they apply rate hikes like we did in the UK and the Euro? Let's take a look. This is one of the most interesting charts I've seen in a long time, and I'll explain it. This shows, in the far right, I circled it in red, this shows the blue line, that's the US. These are rate hikes. We have had 10 rate hikes, and that has brought inflation down. Remember when it touched up around 9% and it's CPI, brought it down to about 4%. The green line is the UK, very close to, similar to the US. The yellow line, very similar, but a little bit lower, is the Euro, the ECB, the European Central Bank. These are the rate hikes that they have applied, and that you can see that where the interest rates have gone. And the conventional thinking is that the U.S., according to Chairman Powell, still has 2 more rate hikes ahead of us. The fear is that with the rate hikes, they're going to crash the economy / the stock market. You know, they're two different things, but the market is probably going to come down as well as the economy, and that's why they keep talking about hard landing, soft landing, no landing, etc. It's going to be caused from this. However, look at the line across the bottom of the page, and I put a black arrow on it. Do you see that red line? That's Japan. 0 rate increases. Really? What's going on in Japan? Why don't they need a rate increase? They desperately need a rate increase because we've seen that inflation is going up out of control. I'm confident that they manipulate their numbers like we do. It's nowhere close to 4% or 4.5%. It's something much higher than that. But that's what they're trying to sell to the public. But the point is, the inflation is going up and up in Japan. No rate hikes. So I read the article about what's going on here, and the issue in Japan is a rapidly rising, aging population. People are getting older. They're very high increase in the number of people over age 80, over age 90, and even age 100. Contrast that with the babies being born. It's called the replacement rate. Is the population having enough babies, children, to come into the country, into the population, relative to those that are dying off? There's about 125 million people in Japan. Last year, the net difference between those who died and those who were born was about 500,000 decrease in population. Now, out of 125 million, that's not a big number, but it's going the wrong way. And they are having 1.4 children per household, and the replacement rate is 2.1. So they are not replacing themselves. This, if you studied population data and demographics, you know that's a big problem. The country cannot grow, and it will eventually become extinct. It'll go out of existence if it continues for a long time. It's going the wrong direction. So here you have a stagnant economy propelled by an aging population and or slowed down by an aging population and a low replacement rate, birth rate. And the second thing is debt. Whenever you see a debt chart, country debt to gross domestic product, which is the economic output of a country, you see Japan and then everybody else. So I'm going to show you this chart. This is from 2018. I was looking to find one as recent as I could. I could not find one. However, the ratio is similar. It has not changed. So I think it's from a concept standpoint, it's a valid chart. This shows where this takes a lot of countries, and it shows on the left by red arrow, Japan. Their debt is 240% of their economic output, gross domestic product. Next to that are three bars. The G7, which is 119%, 19%. The G7, the G20, 20 nations, is 113%, and the US is 108. So all of those are grouped at about, these are developed countries basically. They're all grouped similarly. So let's say 100 to 120%. Japan is at 240%. So you know how bad the US is. I've shown you data on the debt. The US is 31 trillion in debt, and that debt, we're going in the hole about $1.5 trillion a year, and the interest rates have shot up quite a bit. So the interest rates that banks are charging and so forth, this all gets passed through to the government. So they have to pay for their debt the same that everybody else does. So much higher interest rates on a much higher debt, and we're running in the hole about $1.5 trillion on top of that. So we have our own problems. But look at where we are. We're way worse off than a lot of other countries, but compared to Japan, it makes us look like we're doing pretty well, but we aren't. So Japan is in trouble because of the aging population, the replacement rate on new babies, the debt, and basically a slowing economy. And inflation going up. It's not out of control, but what's next, in my opinion, will be it will go out of control because that red line, they are not raising rates to slow down. They should do it. Why do we do it in the UK and the Euro? Why do they do it? We all do it because we have to, or we're going to have hyperinflation. It'll go out of control. And Japan, not one rate increase. That is going to be a significant problem, and it is coming upon us. Now, I want to say that's not going to happen tomorrow. It's probably not going to happen next month, may not even happen this year. But as you look out from the people that I study, I'm going to say it's probably in a range of 2 to 7 years. There are people who emphatically say it's going to be in the next couple of years. But there's others who say this is a large macro direction of the demographic shift and debt and so forth. And it is going to come, but we're a few years away from it. I've seen numbers that go out as far as 7 years. There's people who think in 5 years. Okay, so it's somewhere, in my opinion, between 2 years and 7 years. I mean, I know there are people who think it's going to happen within the next 12 months, but that's not a commonly held view. So I'm going to say 2 years to 7 years. What's going to happen likely, the direction this is going, and Japan's already signaled they cannot afford a rate increase. It will crash the economy, probably crash the stock market in Japan, and reverberate because of the size of Japan, reverberate throughout the world. So they have held off and are now going to face hyperinflation, I believe. And what that means is a collapse of the currency. So you've got sky-high debt, out of control inflation, no ability to slow it down, called rate hikes, no willingness to slow it down, rapidly aging population, low birth rate, 1.4 instead of 2.1 or greater, and they're headed toward hyperinflation. This means, as I said, a currency collapse. The stock and bond markets are likely to collapse with that. So you've got a collapsing economy, stock and bond markets collapsing, and that is going to reverberate throughout the world. This is not Zimbabwe or Venezuela. This is a major G7 country. And because of that, everybody has ties to Japan. We buy a lot. They're a trading partner with us. So we buy a lot of electronics and cars from them. So do people around the world. So they're a significant economy. I don't know what this means for other currencies around the world or hyperinflation around the world. I think this is limited, at least at this point, limited to Japan. But the repercussions of it in Japan's stock market and bond market are going to be felt all over the world. Any of the G7 countries easily. If their currency collapses and their markets collapse and real estate collapses, believe me, that will be just the same as the US collapsing. That'll be felt around the world. So it has a very, in my opinion, has a very high chance of having a domino effect. And I believe that Japan will be that first domino. So what can you do about this? First thing you do, in my opinion, that I do, have food. We may have food shortages, severe food shortages around the world. We've not had that in the US, at least most of us have not experienced that, but have an independent source or sources for where you get food. Secondly, think of your income. Wherever you get your income from, how secure is that income? Do you need to add another source or sources to get income in the event of, let's just say, a global depression? When it hits something of this magnitude, this is going to take down the stock market to levels that maybe we've not known in our lifetimes. It could be the stock market could go down 50 to 75%. Same with the bond market. I don't see how it can avoid falling at least 50%. And real estate, I think, is going to collapse because people are just not going to have the money to buy real estate. And that real estate relies on people being, having the ability. Someone sells, someone buys, and as one sells, they go buy something else. So there's this kind of a rotation that happens with real estate, but it all relies on growth. And so a contracting economy and a collapsing stock and bond market is going to lead to less available funds. And I think when something like Japan, something of that magnitude happens, it's beyond the ability of governments to issue bonds, to prop it up anymore, and the inability to adequately print money, or else they're going to end up in the same boat. I don't know what this means. It gets too far out there and too many assumptions to say what is it going to mean for the U.S. or the part of the U.S. that you live in, or other parts of the world. I think it'll have different effects. But I can see it coming because I don't see Japan has got any options. They're out of options. So when they piled up this much debt, they were not planning on printing money and having no rate increases at a period like this. I think this has come upon them. It is not being talked about in the press. Financial advisors certainly don't, traditional financial advisors certainly don't want to talk about it. But I don't see a way out. So again, I'm doing this kind of as a preventive measure to say, beware, be careful, be prepared, get prepared. If you're in a traditional buy and hold portfolio, like people were in 1929, I think in this 2 to 7 year period, if I'm right, they are at high risk of collapsing significantly, both stocks and bonds. When it happens and when they start to collapse at the rate of go down 20 or 30%, and all of a sudden people start panicking, realizing there's nothing they can do to prevent the further fall, people are going to be looking for answers. That is not the time to be looking for answers. What I'm trying to say right now is get prepared today for that happening. If it doesn't happen, then no harm, no foul. But if you are prepared, then it won't be a surprise to you and you have a better chance of surviving it. We use a tactical method of investing. We don't believe in the buy and hold approach. We're going to be moving out of the market. That's the way our model works in a collapsing market. So, but if you've talked to financial advisors, you know what they said in 2022. That was nothing. 2022 was not a collapse. It was a declining market of both stocks and bonds, but not a collapse. And you know what the traditional financial advisors were saying. I've talked to many of you and you've told me. And so need to be prepared. If you want to talk with me, give me a call. I'll be glad to give you another set of eyes on what you're doing. Okay, now I'm going to shift gears. This is an interview that Morgan Brennan from CNBC did with Sam Stovall. And this will be, if you have an optimistic view, a short-term view, like the rest of this year or the next 12 months, let's say, if you have an optimistic view that the market is going to go up from here and you want to hear information that supports that view, then this commentary by Sam Stovall, who's a well-known researcher, will support that view. So I'm going to play this clip that Morgan Brennan does with Sam Stovall. Take a listen.
Let's bring in Sam Stovall from CFRA. Sam, great to have you on the show. I mean, you called it at the beginning of the year. You said this was going to be a bullish year. Does it continue?
Yes, I think it does, Morgan. Good to talk to you again. And I like to point to history. Obviously, history is a great guide. It's never gospel, but it does give you an idea that if the market does fairly well in the first half, then you probably have a lot of portfolio managers who feel like they have to play catch up. And so what traditionally happens then is we end up with a good second half. And also, depending on how much the first half has risen, gives an idea of how well we'll do in the second half. On average, the market's up about 4% in the first half, whether it's up or down. It's up 5% if it's the first half is up. The second half is then up 6% if the first half was up more than 5%. And as we're seeing right now, with the S&P up more than 10% so far, if that carries through to the end of the first half, history says we could see an 8% gain in the second half.
Interesting. I wonder how granular you've gotten in terms of digging through history and looking at this pattern. Is it a situation where what's worked in the first half tends to work in the second half, or does rotation factor in here?
No, what tends to work in the first half does continue to work in the second half. I looked at the 11 sectors in the S&P and basically found that in the second half, if you had a positive first half, then by letting your winners ride, not only did the market go up on average about 78% of the time in that second half, but then the three best performing sectors at least equal that advance, but outperform the market about 60% of the time. So basically you're equal to or better than the market 6 out of every 10 times. And so that could even be looked at from a sub-industry perspective. So digging down even a little bit deeper than the overall sector.
Now, I'm going to, he referred to this, but I'm going to show you this chart. This is a very interesting chart. In this chart, there are two lines, the blue line and the yellow line, brown line. The blue line is the S&P 500. This measures from December of last year, the end of last year to present. So this is about a 6-month chart of the S&P 500 represented by the blue line. However, there are 7 stocks in that 500. 7 stocks represent all of the gain of the S&P 500. If you take those 7 stocks out of the 500, you're left with 493 stocks. The brown line represents the 493 stocks. On average, the 493 stocks have lost money in 2023. The market is not up when you take out those 7 stocks. And those are the big tech stocks, Apple, Amazon, NVIDIA, Tesla, Facebook, Microsoft, etc. You take those companies out of there and you've got the brown line. So the market has gone up, this represents about 7-8%. This is to May 16, so it's a little bit dated. So it's about a month out of date. But during this time period, the market went up about 8%. Take those out, the market was negative. So it is not a broad market rally. It is a few stocks that are holding up the rest of the market. When you go back to 1998, similar thing happened. There were 11 stocks that were holding up the market in 1998. The rest of the market was negative. 489 stocks on average were negative in 98. You go to 1999, there were 6 stocks that were propping up the market. 494 stocks on average were negative. 99 was an excellent year in the market, except unless you owned those 494 stocks. And it was wonderful if you owned some portion of those 6 stocks. But we know what happened after that. In 2000, the market began its 3-year collapse. And the S&P 500 moved down in that 3-year period, declined about 38%. The technology stocks, the .com stocks that were holding up the market dropped 78% beginning the very next year in 2000. Yahoo, I remember this. Yahoo went from 118 down to 8. Microsoft went from 120 down to 20. Those were the fortunate ones. Most of them went bankrupt. And the top performers in 98, 99 collapsed in 2000. Now I'm going to jump over to a couple of clips on crypto. Crypto has been doing well lately, so this is just a brief description of what's been going on with crypto. I'll play this and then I'll introduce the next one.
Today, Bitcoin rises again, crossing the $31,000 mark to end the week. JP Morgan is expanding its blockchain-based payment rail to include euro payment transactions. And CoinDesk's Michael Casey breaks down crypto's biggest challenges in 2023. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Crypto prices continued to rally to end the week. As of noon Eastern, Bitcoin climbed above the $31,000 level, at one point hitting its highest level in more than a year. Ether crossed the $1,900 level, and Solana rose slightly, trading at nearly $17. Bitcoin and Ether are on pace for a winning week, building on gains driven by institutional interest in the future of crypto.
Now, this next one is Katie Stockton is being interviewed by Joe Kernan on CNBC. And I noticed this one because I had the privilege a couple of years ago of meeting Katie Stockton at an investment manager conference. She was a speaker, and she runs a research firm in the New York City area and sells her research to Wall Street. She follows technical analysis. So she's going to speak in terms of some of the technical analysis around crypto. So take a listen to Katie Stockton.
Bitcoin has been rallying this week. The market has not been rallying. It's sort of, again, taken almost as a contrarian indicator. Usually it's risk on, risk off. But it did rally, if you recall, before. It sort of led the move higher, and it didn't lead the move, but it moved before stocks moved higher. So it did it again. When it got down to 25,000 recently, did you think it was going to breach that level? And were you surprised at how fast it went back above 30?
Yeah, I mean, it held that support level. It was a successful test, and it had seen a loss of intermediate-term momentum, but most of our gauges still pointed higher. So we now have a short-term breakout in Bitcoin, a little bit of room to resistance, which is now 32,000. And that's an important level, by the way. If we see Bitcoin clear that level, it's effectively a bullish reversal on the chart based on our cloud model. So that's a key level for Bitcoin. At the same time, we saw Ether actually come down to its 200-day moving average, which is still rising, and hold support there. So the action is constructive. It makes me feel better about equities to see Bitcoin rallying. I think it's somewhat unrelated perhaps, but we get nervous when we see Bitcoin down sharply in terms of the risk appetite out there.
If it got through 32,000, what's the next resistance?
It's roughly 36,000, which seems like it'd probably be, achievable with that kind of bullish reversal. Okay. And that's based on a Fibonacci retracement level, something very common for currencies.
Now, this is a chart showing household debt. What are the sources of household debt? And there are three. They're colored. They're in bands, and most of the debt is mortgage. No surprise. So that's the brown area in the bottom. There are two larger bands. One is purple and one is red. That represents, the purple one represents auto loans and the red one represents student loans. But if you go all the way back to the beginning, this takes you all the way back for the last 20 years, back to 2003, student loans were very, very tiny. And credit card debt was much less. So credit card debt has expanded, student loans have expanded a lot, and of course, mortgages have expanded. Debt and the economy go in cycles. We're at the top of a cycle. Maybe it will go on higher. Maybe the debt will go on higher and the economy underneath that debt will go on higher, and that people will be able to support that debt. But the higher it goes, the greater risk that people have. And when the economy comes down, the market comes down, and a number of jobs go away, and people end up defaulting on debt. So it is dangerous territory to have an amount of debt that a person cannot support. When you look at I played the scenario of Japan, the reverberating effects throughout the world economy, probably in the next 2 to 7 years. That's my opinion. And when you look at that, having too much debt, regardless of the source, adds to the problems for any household. Where's money going? The flow of funds report. What's interesting is that, no surprise, this has continued to happen. Money is coming out of equity funds, 17 billion, 3.9 billion coming out of bond funds, and 36 billion going into money market funds. Apparently, he stopped watching CNBC. Well, I've told you before, I got rid of my TVs, and I don't watch that. I do read the news online, and I do it selectively when I want to, and I don't have a TV going. So if I had a TV, it would probably be on too much. So, yeah, I know that the news sources, the financial news sources, have a bias, and that they can be negative. And so I try to find people, regardless of the source, who I believe are credible and who present their information that is backed up by data in a credible way. Thank you for watching. If you have questions or comments, leave them in the comment section below. And if you have a portfolio, you want me to take a look at it with the concept of active management, I'll be glad to do that. There's my phone number and email address. Let me know. Thank you for watching.